Okay, the topic is statement of cash flows. Very interesting and very important um, financial statement. Cash flow statement is actually your third financial statement in the sequence, because first you prepare your income statement. Once your income statement is done, then you prepare your balance sheet. And once the balance sheet is done, after that, you make your cash flow statement. So cash flow statement cannot be prepared without income statement and balance sheet. Number one thing you remember. Why do we prepare cash flow statement? There are several reasons. Number one reason is that your income statement actually is prepared on accrual basis. Accrual basis means that in income statement you write down the revenue. For example, $1 million. Now, your customers might not have paid you anything, but because you have sold the goods or you have provided the services, so you show the revenue. Similarly, you put your expenses there. You never say expenses paid. You always say in your income statement, administrative expenses, $5 million, for example. So maybe you have not paid all of them. Then you write down your interest expense. You never say interest paid in income statement. In income statement, you always say interest expense. You calculate your interest expense for the year and you write it down there. It does not mean that you have paid it. So what happens that because income statement is prepared on accrual basis, which means that whether you have paid expenses or not paid, you write them all. Whether you have received income or not received, you write it all. So it is quite possible that on your income statement, you see that you have got a profit of $1 million. But then I ask you, how much cash do you have? And you say only $50,000. So me being the shareholder, when I saw you showed me income statement, oh, we made a profit of $1 million. I became very happy. And I said, now give me this 1 million. And you say, sorry, I don't have 1 million. I've got only 50,000. Oh, why do you have only 50,000? You just made $1 million in profit. You said, yeah, because profit I calculated based on accrual basis. So a lot of people have not paid us money yet. We are still waiting in receivables. Maybe we have purchased some inventories. Maybe we have purchased some non-current assets during the year. So there is a difference of 950,000. This is missing. Okay, guys, 950,000 is missing. Because you told me profit 1 million and cash is only 50. So where is my 950,000? And then you say, Mr. Ali, we purchased some non-current assets during the year. So some of the cash we spent there. Okay. Then we purchased some inventories. So some cash lies in inventories. Then we have some receivable because customers are not paying us money. So some of the cash is lying in receivable. So there are a lot of things which are, as a result, which create that difference. So I'm actually now kind of confused. This 950,000 is missing, and that is making me quite worried. And you say, you see, this is the balance sheet. Balance sheet is showing $50,000 cash. I say, this is also on paper. How do I know that this 50,000 which you are showing me on the balance sheet is correct number or incorrect? Maybe there should be 300,000. Please prove it. Please prove it that the cash which you show me on the balance sheet, which is just 50,000, that is the correct number. Otherwise, I cannot sleep at night. 950,000 is missing. For this purpose, we prepare cash flow statement. Okay. So number one, we reconcile the profit on the income statement with the cash on the balance sheet. And then a lot of investors, they don't give you money on paper, they give you money in cash and they want cash back. They want to see how much cash a business is generating. So a lot of investment decisions are based on the ability of a business to generate cash. Okay. So we want to see not only profit, we want to see cash, because let me tell you, when you say bankruptcy, bankruptcy is not the name of absence of profit. Bankruptcy is the name of absence of cash. Okay, so it is quite possible that there is a company which is profit in 1 year, profit in 2 years, profit in next year, profit in next year, and then boom, it goes bankrupt. And you say, oh, they have been making profit for the last 5 years, but they go bankrupt because they don't have cash to pay their liabilities. So bankruptcy is the absence of cash, not the absence of profit. So it is possible that you have got $1 million profit and you've got zero cash because you purchased non-current assets, you invested in some projects, your customers are not paying you money, your inventories have been piled up, so you've got zero cash. On the other hand, it is also possible that you have got zero profit, no profit, but you've got plenty of cash. I say, how much is profit? You say zero. How much is cash? You say $500,000 I've got. Oh, where did you get this money, by the way? You didn't make any profit. Where did you get that money? Because, it's not how much cash do you have. We also want to see that where this cash is coming from. Where this cash is coming from. So when you say I made zero profit and I've got $500,000 in cash, I want to see where it came from. I found out that probably you have taken a loan from the bank. You have taken a loan from the bank, or probably you have sold some non-current assets and you generated cash. So profit and cash are two different things, okay? So profit is shown on the income statement, which is, an estimate. Profit is an estimate of based on your accounting policies. Profit number can be manipulated, can be changed like this. Profits can be manipulated very easily by changing the accounting policies. You just make your depreciation from straight line to reducing balance, your profit will change. You will just create a provision, 0.5% more, 1% less, your profit will be changed. Remember, your profit can be affected with your, so many estimates. So profit can be manipulated very easily. Cash is a reality. Cash is king. If there is $100,000, it is $100,000. Nobody can count it more or count it less. It is 100K, it is 100K. So investors in many situations, they really are interested in seeing what is the cash situation, how much cash a business is generating. So we prepare cash flow statement to serve these purposes, okay? Now, how do you make the cash flow statement? Like I said, that cash flow statement is the third statement in the series. The first one, income statement. Second is the balance sheet. Third is the cash flow. And to prepare a cash flow statement, what do you need? You need two balance sheets. You need a balance sheet from the last year. You need a balance sheet of, this year, which I call current year. And you need an income statement of this year. So if you want your balance sheet, if you want to make your balance sheet, or you come to me and say, Mr. Ali, can you make a balance sheet can you make a cash flow statement for my business? I say, yeah, I can. Please give me this year income statement and balance sheet, two statements from this year, IS and BS, and bring me the balance sheet from the last year. So when I have two balance sheets with me, and like last year and this year and one income statement, I can prepare cash flow statement maybe in less than an hour. I just need the numbers, 3 papers you give me on the table, and we will put them together and we will prepare our cash flow statement, okay? So this is a general overview about cash flow statement. I don't want to go into a lot of details, just one last question statement, and I will stop this overview of cash flow. You know that we have done interpretation of financial statements. We interpret financial ratios. So there is a very interesting topic of interpretation of income statement. Then you have interpretation of the balance sheet. Trust you me, interpretation of cash flow statement is eye-opening. Interpretation of cash flow statement is the most interesting interpretation, and it shows you a lot of hidden things, because in balance sheet and in income statement you do a lot of adjustments. Cash flow statement brings everything on the surface, and if you really want to, if you learn how to understand and interpret cash flow, you understand what is happening in the business. So anyways, statement of cash flows. This is a very brief, short introduction about this thing. And now let's start the chapter. So we continue. We just had this short overview about cash flow statement and purpose. The statement of cash flow shows the movement between a company's cash and cash equivalents. So within cash flow statement, there are no accruals. You only record the items which are cash items. For example, cash coming in, cash going out, okay? And therefore, depreciation is not included there. Provisions are not there. Any accruals are not there. Bonus shares are not there. Revaluations are not there. All these things, impairment is not there. So impairment of asset, revaluation of asset, depreciation of assets, issuing of bonus shares, because bonus shares do not have cash. So all these things are not included. It will include only and only those transactions which would result in increase or decrease in cash. And then there are two words, we call it cash and we call it cash equivalent. Cash is cash. We all know what is cash. Cash equivalent is any asset which can be converted to cash readily, immediately, and at a known amount. The amount should be known. So for example, if you've got a check in your hand, so I've got cash, which is $200, and I've got a check, which I can go to the bank tomorrow morning, and it says $300. My total cash and cash equivalent is 500. So this check is cash equivalent because I can convert it to cash anytime. And when I will go to the bank will give me 300, no more, no less. It is very important that it should be converted to cash immediately and at a known amount, which means that amount is known. If you talk about shares, shares are not cash equivalent because shares can be converted to cash very easily in the stock market, but the price is unknown because share value is always changing. Similarly, gold is not cash equivalent because gold again is a very liquid asset. You can sell it anytime. Even you can sell it on road. But the thing is that the price of the gold, the value is unknown. It is very important for cash equivalent that you should have a known amount, a known value. So this is, I already have discussed. What is the difference between profit and cash, benefits and drawbacks of users? I told you interpretation, etc. So cash and cash equivalents, cash flow, statement of cash flow. Now, what happens that you've got hundreds of different types of cash transactions, and you cannot just start putting them all of them together. What you need to do, you divide them into three categories. You call it operating cash flow, investing cash flow, and financing cash flow. So I group these transactions, the cash transactions, whichever they are, I put them into three different categories. We call them cash flow from operations or operating cash flow. So you might have operating inflow, operating outflow. Then you have cash flow from investing activities, number two. So you call it investing outflow, investing inflow. Outflow means when cash is going out, inflow means when cash is coming in. And then you've got financing activities. Now, what are these activities? I will explain a little while. What are the examples of these and this and this? Okay, so I'll explain, don't worry. Then to prepare cash flow statement, there are two methods. You call it an indirect method and a direct method. Direct method is easy, but it is not used a lot of time. Indirect method is little bit more complex, but this is the method which is generally used in the preparation of the cash flow statement. Indirect method. And by the way, let me just tell you that this direct or indirect method, which I mentioned, it is only for operating activities. Like operating activities can be prepared either with this method or with that method. So preparation of operating activities. The first part of the cash flow statement is the operating part. Second is investing part. Third is financing part. This operating part can be made in two ways, in two methods, indirect or direct. Investing and financing are same. Investing, financing there are not two different methods. There is only one method. We use indirect method mostly. In some cases, now that's a very different topic, that why do we not use, or when should we use direct method or indirect method? That's a different thing. Uh, Generally, indirect method is preferred. Now that's another debate we'll discuss later. Purpose, I already have explained you in the overview what is the purpose. That a statement of cash flows, it shows the effect of an entity's commercial transactions on its cash balance. So whatever business you are doing, buying and selling goods, how it is impacting your cash balances. And it is thought that users of accounts can readily understand cash flows. Because when you come and you say that my profit is 1 million, and I say, show me the profit, how did you calculate it? And my cash is 50,000. So this 50,000 cash is very well understood. I can see it on my table. But this number is hard to understand because you created provisions, accruals, and estimates, and so many things. So cash is easily understood. Format, 3 types of activities. First part, operating, middle is investing, bottom is financing. What are operating activities? What are operating activities? This section of the statement of cash flows shows the cash and cash equivalents generated by and used in the entity's main trading activities. These are your main trading activities in which you are buying and selling goods. So whatever cash is received or paid for generating revenue and incurring expenses for doing your main trading activities, that comes in your operating cash flow. For example, when you receive money from customers, it is operating cash flow, operating inflow. When you pay money to your suppliers, when you pay cash to your suppliers, it is operating outflow. You pay your operating expenses, electricity, salaries, and others. All these are your operating outflow. These are operating expenses. You pay interest, it is operating expense. Interest is operating expense. So cash received from customers, cash paid to suppliers, operating expenses, taxes paid, interest paid, dividend paid, and actually I should say operating expenses paid, okay? Received, paid. It's not like when if I say that you have interest expense, it does not mean that you have paid. It only means that you have expense. And then the second question comes up, how much is interest paid? So this interest expense, this goes to P&L, and interest paid, it goes to the cash flow statement. Now, your statement of cash flows, actually the correct name is statement of cash flows, okay? So you have statement of cash flow. It is possible that your interest expense is $100 to the bank, but in your interest paid is only $20 because you have not paid $80. So 100 will go to the income statement as interest expense. Only 20 will come to the cash flow statement, which you actually have paid. These are your operating cash flows, okay? Now, there is one thing which sometimes create confusion, and I want to bring clarity to that. This dividend paid. Actually, dividend paid can be shown in financing activities, and it can also be shown in operating activities, just like I have put it here. Now, if you open up your BPP book, in BPP, they put dividend paid under financing activity. This is BPP doing. If you open up your Kaplan book, Kaplan is putting it under dividend paid under operating. So Kaplan is treating it under operating. BPP will treat it under financing. Now, which one is correct? We go to IAS 7. We say that let's see what IAS 7 tells us, the cash flow statement. And IAS 7 says it does not matter. You can write it in financing, you can write it in operating, doesn't matter to me. But you have to decide it once. If you decide to put it in financing, then keep it always in financing. And if you decide to put it under operating, then keep it always under operating. But yeah, anyways you can put, but make a consistent approach. So if you ask me where should we put it, I would suggest, I would rather put it under the way which Kaplan is doing, operating. I will keep it as operating activity. So three things I will put it in operating: in tax paid, interest paid, and dividend paid. Okay. So don't take it to financing. Then you have cash flow from investing activities, which is the second part or second section of your cash flow statement. In investing activities, what are the investing activities? Which a business is doing investment, which means purchase of non-current assets, sale of non-current asset, investments which you make in other associates and subsidiaries. Remember consolidation. Investments which you will make in other companies, they will come there in investing. So when I make investment in some company, it is my investing outflow. Why do I make that investment? Because I want to receive the dividends. So when I receive dividends, that will be my investing inflow. Remember, dividends are of two types. One is dividend paid. Dividend paid was some confusion, maybe investing, maybe financing. I said, I'm sorry, maybe operating, maybe financing. I said dividend paid, put it in operating, okay? Put it in operating, dividend paid in operating. But you might also receive dividend. When you receive dividend, that goes into your investing activity. So investing activities are buying and selling of non-current assets. You buy non-current asset, it is cash outflow. You sell non-current asset, it is cash inflow. Buying and selling of shares in other entities, not your own entity. Like I said, you make investment in an associate, you purchase someone's shares, 10-20%. It comes into buying and selling of shares in other entities. So when you buy, cash goes out. When you sell, cash comes in. And investments made and dividends received, they come under investing activities. The last section of the statement is going to be your financing activities. Financing means that when you are sourcing finance into the business, you are putting finance into the business. So it includes issuing the shares. So what is buying and selling of own shares? Remember, in investing activities, you buy and sell shares of other companies. It says buy and sell shares in other entities. This is investing. But when you buy and sell your own shares, that is financing, because what is the purpose of issuing shares? You want to finance the business, or you take loan, or you return loan, taking and returning back loans. I go to a bank, I took a loan, it is called financing inflow. When I return back the loan, it is financing outflow. But when you return back the loan to the bank, the loan will include two amounts, principal and interest. Principal part will come here under financing activity. Only principal amount will be shown. The interest amount will be shown in your operating activity. So these are few basic categories of cash flow statement. Okay. Like I said, operating activities, investing, and financing. Okay, now we say that operating activities, the first part of the cash flow statement, how do we prepare it? It has two methods. Like I said before, that operating activities can be prepared in two ways. One is called your direct method. The other one is called the indirect method. Direct method is rather easy. I'll just go very fast, very quick on that. And then we will spend more time on indirect method, which is slightly complex and which is actually used in exams and which is used in real life. So direct method will go very fast, okay? How fast I can go on direct method? Let me show you. I can go this much fast. It is done. Okay, just kidding. So let's go back. Like I said in the very beginning, that cash flow statement you need to prepare with 3 financial statements in your hand. This year income statement and balance sheet, and last year balance sheet. So 2 balance sheets and 1 income statement. So I see like this here. I've got 2 balance sheets. I have a balance sheet from 2020 and 2021, 2 year. This is last year, this is current year. And I've got income statement. Now you see that these statements, both of them, they do not provide you some of the information. For example, it says that I've got sales of $100,000. This is shown in the income statement, and this is accrued basis. I don't know how much cash I have received from customer. If I ask you that cash received from customers during the year, okay, how much during the year in 12 months you have received cash from customers? You don't know. Income statement says I sold goods for $100,000. The balance sheet says that I have got receivables of 12,000. So how much cash have you received during the year? It's very logical. So this is how we are going to show you that why or how do we use the 3 financial statements. See, your opening receivable was 10,000. So I had a customer. Just imagine it is one customer. In the beginning of the year, this customer, he owed me $10,000. And then I sold him goods for $100,000. Okay. So now this customer should owe me $110,000. Logically speaking, 10,000 you owe me in the beginning. On 1st January, you already owed me $10,000. And then I sold you goods for 100K. And I say, okay, now you owe me 110. But the balance sheet says that the closing receivable is only 12,000. So where is the remaining cash? Why it is not, 110? It is not 110, it is only 12. So it means that the remaining cash has been repaid. So cash received from customer is 98,000 under this situation. Under this situation, cash received from customer is 98,000 because receivables are increasing. If you see that receivables are increasing, so if I don't make it like this, it looks a little bit lengthy, but this is the logic. I can do it very quickly. I can say that if my receivables had been same, let's suppose that my receivable opening were 10,000, closing was 10,000, receivable did not change. So it means that whatever I sold, I received all of the cash. Then I can say that cash received is 100K. If opening receivable and closing receivable are equal, then I would say that whatever I sold, I got my cash because this amount remains same. But in this situation, what is happening? That receivables are increasing by $2,000. So it means that some of the customers did not pay money. So out of this 100,000, actually 2,000 did not come to me. So what I got was only 98. That's what it says. You can put it like this, you can put it like this. Similarly, if I ask you that not cash received from customers, how much is cash paid to suppliers during the year? How much is the cash paid to suppliers during this 2021? How do you find it out? You will say, okay, what are my payables? Opening balance. My payable opening balance was $8,000. I owed to my suppliers $8,000. And then I made some purchases, which are 60,000. So you see, I'm using 3 of them, all 3 of them. So it means that my balance payable to my supplier should be $68,000. But it is not 68,000. It is only 6,000. So if it is only 6,000, it means that I already have paid to my suppliers $62,000. I will say cash paid to supplier is 62K. You can see it in this way as well. How much did I purchase? 60K. What happened to my payables? My payables have decreased from 8,000 to 6,000. What does that mean? It means I have paid all of this thing, which I purchased new, plus I paid 2,000 from my old payment, from my old balance. So I paid out all of that, plus because my liabilities are decreasing, my payable is decreasing, I paid 2,000 out of that as well. So cash paid to supplier is 62,000. You can do it with all of these lines: interest expense, income tax expense, in the same way. If I ask you, how much is your expense during the year? You say 3,000. Did you pay all of that to your bank? You say, no, I'm not sure. This is expense. So how much actually you pay to the interest to the bank? So I'll say 3,000. So I'll say, what is the opening interest? Opening interest is 2,000. How much is interest for the year? 3,000. So it means that I should have a $5,000 balance interest payable on my balance sheet, but I see zero. It clearly means that all 5,000 has been paid out. So cash interest paid is 5,000. So you see that in income statement, you will say that interest expense is 3,000. In cash flow statement, you will say interest paid is 5,000. That's all these numbers. And the same way you can do the tax as well. If anybody does not understand, please ask me. So this is what I just was doing it with the pen. You can see it here: cash paid to supplier 62K, tax paid 8,000, interest paid 5,000. Okay. So this logic we will use in calculating the direct method. We said that the first method which we are going to use for preparing operating cash flow is the direct method, and this logic we will use there. So what does it says? So like we said that you will have three parts of the cash flow statement. You will have your operating activities, you will have your investing activities, and you will have your financing activities. So these are the three. And this is called your operating cash flow, investing cash flow, financing cash flow, and of course, this is your net cash flow. So what is included in operating? Cash received from customers, 47,300. How did you calculate that? I just explained to you: opening receivable plus sales minus closing receivable. Cash paid to suppliers, same way: opening payable plus purchases minus closing payable. Cash paid to and on behalf of employees, which means that you paid salaries to employees and you paid their taxes and whatever. 15,000 outflow. Interest paid 4,400, and that gives you $600 negative operating cash flow. So you are actually not generating any cash from operations, which is a very bad sign, by the way. Although the company does have so much cash, you see they have so much cash, 63,000, but from their trading, from their operations, they are not making any cash. They're actually they do not even have money to pay their salaries. They are in loss. They are in negative cash, actually. So where the cash is coming to the company? From the customer suppliers buying and selling goods, they are not making any cash. Where the cash is coming? Now, I'm not saying they are not making any profit. They might be making profit, but they are not generating cash from customers. So it comes up that payments to acquire tangible fixed asset. So they actually are not making any cash from operations, and they went out to buy intangible asset. They purchased some PPE for $40,000. This is again a negative cash flow. So did they have money to buy this PPE? They were not even generating cash from operations. On top of that, somebody thought that they should buy some asset as well. So where did they get this money from? From financing activities, because they took a loan for $60,000. And then they issue some ordinary shares for $50,000. And they did return back some loan, but that is very little, 6,000. So their financing cash flow is 104,000. It is 104,000. If they had not taken this loan from the bank or issued these shares, they would not have been able to pay their salaries and they would not have been able to buy the asset. So if you really want to see where the money comes from for buying these assets, it is all coming from here. And you are very happy end of the month. Oh, I've got $63,000 on my table. I've got $63,000 in my bank account. Don't be happy. Don't be happy, actually. I mean, you just took a loan and issued some shares. This is financing cash flow, which you are seeing on your table. Your operations are not generating anything. Why they are not generating anything? There are two possibilities. One, you are making a loss. Two, you cannot collect your cash. Or you have built up your inventories. In all three cases, it is not a sign of a good management. In my opinion, this is not a sign of a good management because your operations should generate cash flow. Your operations are sucking your cash. And to feed your operations, you are taking loan from the bank. What are you going to do next year, by the way? Either you are making a loss or you are not able to collect your money. You receive very little money from customers, or probably you are building up inventories or something. You know, you are building up receivables, you are building up inventories and so on. So anyways, it's very important because when you came and say, oh, I've got 63,000 in my bank account, you know, cash is cash. It does not say where it came from. $100 bill is $100 bill. It does not tell you where it came from, but you really want to see where it came from. You understood it now that it came from a loan or probably issuing of shares. So this is a very simple way of preparing cash flow statement, direct method. As I said, I don't want to spend a lot of time on that. Whatever I've explained to you, that is enough for this purpose, okay? Next method, we are going to use indirect method, okay? Now, this next part is about indirect method of preparing this cash flow statement. And like I said, that this difference of direct and indirect thing applies only to the operating section, okay? Investing and financing, in both cases, they are done in the same way. Now, before I explain you this operating indirect method of preparing operating cash flow, let's get clear on one concept. That concept is, let's do like this. I'll explain you some numbers. For example, you've got sales of 100, and let's suppose that it is all cash. You've got cost of sales, and you paid all of your suppliers. So you've got a gross profit of 50, which is in cash. And then you say, oh, I've got my admin expenses 10, I've got district expenses 10, depreciation of 5, Mr. Ali, net profit is 25, and take this $25 cash and please allow me, I want to go home. So you show me this 25 and you say, take your cash 25 and let me go home. I say, whom did you give this money? And you say, this is, I have received it from customers. This is $100 I have received from customers. This is 50, I paid to suppliers. This is 10, you see, I paid rent. What is this 10? I paid some transportation. Where is this depreciation $5? Whom did you give it to? You said, no, I did not give it to someone. So if you did not give it to someone, it is not here in cash flow statement. So you did not give it to someone. So where is this 5? You say, oh, I remember now. That $5 is in that drawer. I'll just go and bring it back. So it means that your cash is actually 30. In your net profit is 25, your cash is 30. So what you do, the idea is that in indirect method, you start with the profit line. That how much is my profit? My profit is 25. And after that, you start making add back and subtract. Add back what? Add back any non-cash expenses. What is the non-cash expense here? The non-cash expense is $5. Please add it back. But then you come and say, oh, I remember that there is some non-cash income as well, because some of the customers did not pay money. I only got 97, $3 I still have to receive. This is non-cash income. So then you say, okay, I subtract it. So your cash balance is 27. So the basic concept in indirect method is you start with the profit from the income statement, which you already have calculated. And then you see that what are the non-cash income and non-cash expenses? And you add back the non-cash expenses and subtract the non-cash incomes. This is one concept which we will use. It is not the only concept, but this is one concept which we use in preparing the indirect method. So non-cash expenses you add back because you previously subtracted from revenue, but you never paid them out as cash. So cash is still in the business and therefore added back. Remember, we were doing investment. Okay, let's not talk about investments here. Indirect method. Now that's the indirect method. And this is, by the way, only the operating part. Investing part and financing part will come later. So it is slightly long. This whole page is dedicated to the operating part. It might look a little bit challenging or confusing, but if you split it into 3 parts, it will become very easy, okay? So I will actually put it like this. This is the first part. So operating section, I also divide into 3 parts. Operating, I also divide it into 3 segments. Okay. So how do we start with? You start with net profit before taxation. Remember this line. You remember PBIT, profit before interest and taxes. So you don't start with PBIT because PBIT is X. Then you say, this is my interest expense. You subtract it. You get this number. This is called PBT, profit before tax. And you start from here, which means after interest, profit before taxation. I assume a number. My profit before taxation was 3570. And then I say add back depreciation. Remember depreciation we add back? Add back depreciation because it is non-cash expense. And if there is any investment income, because when you make your income statement, you do have some other incomes, investment incomes. So investment income, I am subtracting from here. Why I'm subtracting from here? Not because I might have received or not received. You might have received it in cash. This number is correct, but it does not belong here. Because investment income, I will put it under investing activities. So what happened that when I came to this, I took this number 3570. Above that, there was investment income, which was added. Because you add investment income before. So investment income was actually included in this number. When you took this number 3570, it included investment income, if there was any. Because investment income was somewhere here before PBIT. So because you added it and you said it does not belong to operating, so please take it away. So you subtract it. And then interest expense. Remember, I subtracted this interest expense. But this is expense. I don't know how much I have paid. Maybe I have paid all, maybe I have paid nothing. So I'm not sure about how much I have paid. So I add it back. So these are 3 lines actually. What happens? Remember, I told you convert it into 3 sections. Here, there will be only 3 transactions. interest paid, income tax paid, and dividend paid. Only 3 items, not 4. Here, there will always be 3 items: receivables, payables, and inventories. So this section is very clear. Interest paid. How much is interest paid? Remember, opening interest payable plus interest expense minus closing interest payable. We did that method before. How much is tax paid? Opening tax liability plus tax expense for the year minus closing tax liability. So I can find out my interest paid, tax paid. This second part also has 3 items. Increase in receivable. So you've got 2 balance sheets. Your receivables were 10,000. Then it became 12,000 in the next year. So there is a $2,000 increase in receivable. If receivables are increasing, it means the customers have not paid cash. So your cash goes down. So you subtract it. If you talk about payables, your payables were 6,000. And now your payables have become 5,000. So your payables have decreased by 1,000. So when payables are decreasing, what does that mean? It means I'm paying money to suppliers. My payables are decreasing. I'm giving out cash. So when you are giving out cash, your cash should be less. So you subtract it. And the same happens with inventories. If inventories, they go up, cash will go down. Because why? How inventory went up? Because I probably have paid cash. So, and if inventories, they go down, cash goes up. So a decrease in inventory means increase in cash. Inventories are going down. I sold them and I got cash. So decrease in inventories means add the cash. So this is very clear. 3 transactions. This is very clear. 3 transactions. In this part, you might have 3 or maybe 4 or maybe 5 or probably even 6. This could actually bother you. The first part. So like I said before, that operating part looks little bit tricky, and I'll go back and I'll focus on the first here. But what puts you in relaxation is that last part is very simple. I can do it like this. This is very simple. I can do it like this. What to do with the first part? Start with the profit before tax, and profit before tax, anything which is above that. So PBT, profit before tax number, anything which is above that and which is non-cash, income or non-cash expense. From here, any non-cash expenses are added back, non-cash incomes are subtracted. Okay, so you've got the number. When you put 3570, add back depreciation, subtract investment income. Why I subtracted it? It is not non-cash. I'm not sure. It just does not belong here. It has to go to your investment activities. And you call it operating profit before working capital changes. And working capital means receivable, payable, inventory. Then you make the 3 items which are receivable, payable, inventory. And this is one number, 3920. This is another number, 2730. This is called cash generated from operations. And then you say interest paid. I put it like this. Okay. Interest paid, dividend paid, tax paid, all 3 of them together. And this is your third number, cash flow. So your net result comes out to be 760 or something, whatever. So net cash from operating activities. Now, this is net cash from operating activities, not from the business, just from operations. And then you go to your financing and investing part, which is the same like before. We did it in direct method. Direct method is same. Purchase of PPE, cash goes out, make it negative. Proceed from the sale of equipment. You sold some asset, cash comes in, add it back. You receive interest, you receive dividends, add them up. This is your investing cash flow. And then you come to your financing cash flow. You issued some shares, you got cash, added, you took some loans, added 250, it makes 500. Okay. So now Net increase in cash, and this is 780. And what is 780? What is 780? 780 is the sum total of those three. You had 760 there. Your operating cash flow was 760, if I'm not mistaken. Yeah, 760. So you had here 760 in operating cash flow. So 760 plus minus this number. So 760, 480, and 500. Your cash flow, change in cash flow is 780. During this 1 year, you have generated, the business has generated 780,000. There are 3 zeros on the top. So 780,000 the business has generated. How much was your opening cash from last year? You go back to last year balance sheet, it says 120. So you said, okay, opening cash was 120. During the year, it is 780. So my closing balance sheet should show 900. And this is the test. If your closing balance sheet is not showing 900, let's suppose that your closing, so this is what it comes out to be, according to my cash flow statement. But on your SOFP or probably in your cash, whatever physical, it is 850. Then you start thinking, where is $50? Maybe I made some mistake here. Because that should be equal. So opening plus this year should be equal to the closing cash flow. This is what is your indirect method of preparing your cash flow statement. Any question until here, please?